Stop confusing sales with profits. Welcome to day 1 of the 60-second MBA, where I explain big business grammar with simple English. Today's word is revenue, also known as turnover. This is simply the total amount that enter into your hand before you pay for anything. Before you pay for stock, before you pay for transport, and before you pay for your shop rent. Imagine you sell 50 plates of rice for 1,000 each. That is 50,000 in your hand. That 50,000 is your revenue. Even if the rice costs you 49,000 to cook, that 50,000 is your revenue. Why do investors care? Because revenue actually proves that people want your products. It proves that people want what you're selling. It proves demand. You made sales, but how much did the product actually cost you to make? Today's terms is COGS or COGS, known as cost of goods sold. This is the direct money you spent to create the specific thing you sold, only the materials. Back to our rice business. To make that one plate you sold for 1,000, you bought raw rice, pepper, oil, and meat. Let's say that cost you 600 naira. The cost of goods sold in this case is 600 naira. Please take notes. You don't count other expenses here. For example, your shop rent, the amount you pay your cook, and all. You don't count them here. This is literally only the price that it costs you to make that product. This is just the materials. Investors look at this to see if your product is too expensive. If your COGS is too high, you are working for nothing. Tomorrow, we are going to subtract COGS from your revenue. You sold it for 1,000, but is that your profit? Well, not yet. Today, we are talking about gross profits. This is the money left in your hand after you subtract the direct cost of the materials, which is COGS, cost of goods sold, as explained in the previous episode. This is always before you pay your other expenses, other bills, which, for example, can be the cost of paying electricity bills or paying your staff. You sold rice for 1,000, which is your revenue, but the cost of goods sold to make that rice is 600 naira. Your revenue minus cost of goods sold is what is your gross profit. So in this case, 1,000 minus 600 equals to 400. So that 400 is your gross profit. Investors check this to ensure the core business makes sense. If you don't have gross profits, you technically don't have a business. But can you spend that 400? Hell no. Tomorrow, we talk about the real profit, which we call net profit. This is the only cash that matters if you want to feed your family. Today's word is net profits, and this is the bottom line. This is the actual cash that you take home after paying for everything: electricity bills, payment for staff, shop rents, taxes, and transportation. Remember, our gross profit was 400 per plate. Now remove 100 naira for rent, 100 naira for staff salary, and 50 naira for transport. You are left with 150. And that 150 is your net profit. This is what you actually own. Investors look at this to answer only one question: is this business sustainable, or you are just washing money? What happens when you have net profits on paper but no cash in the bank? Have you ever been rich on paper and broke in reality? That is the cash flow problem. And today's term is cash flow. This is the timing of when money enters into your account and when money leaves your account. It's not about profits, it's about the movement. Let's say you supply an hotel with $1,000 worth of rice. They give you an invoice promising to pay in 30 days. On paper, you have $1,000 in revenue. In reality, your pocket is empty. You have poor cash flow. Investors fear poor cash flows because it kills businesses. You can be profitable and still crash because you ran out of cash to buy stock. Tomorrow, we are going to talk about percentage. Are you keeping 10% or 50% of your sales? If you don't know, you are in trouble. Today's word is margin. This represents the percentage of the selling price that is actually yours to keep. If you sell a recharge card for 100 naira and your profit is 5 naira, that means you have a profit margin of 5%. If you sell a cake for 10,000 naira and your profit is 5,000 naira. That means you have a profit margin of 50%. Investors love high margins. High margins means if the cost of buying flour goes up, your business won't die immediately. You have a buffer. You have something to adjust to. How many items must you sell to start making money? Every business starts by losing money. But when do you stop losing money? Today's term is break-even point. This is the exact number of products you must sell to cover your monthly expenses. At this point, you make zero profits and you lose zero money. Let's say your rent and staff cost 50,000 a month and you make 500 on every shoe you sell. You need to sell 100 shoes to cover that expenses. At 99 shoes, you are losing money. At 100 shoes, you are at break-even. And at 101 shoes, you started making profits. Congratulations. Investors want to know your break-even point to see how risky the business is. They need to understand how hard do we have to work in order to survive. Next week, which may be tomorrow, we'll talk about customers, how to get them, and how to keep them. See you then. Do well to subscribe to this channel and put on the notification button so that when I post the next video, you are going to be there. See you next time.